Welcome, accounting boffins. You are with Ashraf Patel and the crew. Remember, we're dealing with inventory systems. We're looking at specific calculations that you need to be au fait with to fully understand and comprehend what it entails when we're working with the periodic inventory system. All right, so now if we look at our revision again, our recap, what did we say? We said that when you're dealing with the periodic inventory system, the most important component of this will be your purchases account. Remember that? Okay, and when you're dealing with the perpetual inventory system, that's the one we dealt with there, you're dealing with the trading stock account. Okay, so clearly a difference between the two, and this will become evident. This will become clearly evident to you when you see what we're going to be doing now. Right, so watch the space. With the perpetual stock system, right, and how it impacts on the accounting equation. Let's take an example. Let's take an example, and I'm going to do it in a different way to highlight to you the difference between the two systems. Right, so this is what I'm going to do. Number one, bought merchandise for cash, right? Clearly you can see your two accounts involved would be bank and trading stock. So you're going to debit your trading stock account. Why? It's an asset account increasing in value, therefore debited. You're going to credit your bank account. Why? It's an asset account decreasing in value, therefore credited. Just a word about the bank account. Don't take for granted that your bank is always an asset. What do I mean by that? Bank can also be a liability. In that case, your bank account will no longer be regarded as an asset, right, but a liability. However, the account debit and the account credit doesn't change, but the impact on the accounting equation will change. Okay, but this is just a side dish where we're talking about the bank account, right? Where it could either be a favorable balance or an overdraft, an unfavorable balance. So very important, when you're doing the accounting equation component of it, check whether bank is favorable or unfavorable. So yes, it doesn't impact on debit and credit, but it impacts on whether bank is an asset or a liability. So we're assuming now that bank is favorable. So therefore, a debit to trading stock, a credit to bank, watch my accounting equation, my assets increase as trading stock is increasing and my asset is decreasing because bank is decreasing. Okay, so that's the perpetual inventory system. Let's take that same transaction using the periodic inventory system. Watch. Now it's periodic stock system. Transaction is bought merchandise for cash. Same transaction. Account debited is purchases. Note the difference. Account credited is bank. Doesn't change. Notice my accounting equation. We're assuming bank is favorable. So assets minus and owner's equity minus. Why? Because purchases is an expense and it is impacting on my owner's equity. Clear? I hope you fully understand this. Right, your liabilities remain unchanged. So now what I've done for you, I've shown you a comparison of the same transaction but treated differently using the perpetual inventory system and the periodic inventory system. Let's take another one. Here we go. We're doing bought merchandise on credit, right? Account debited will be trading stock, asset increasing in value. Account credited will be creditors control, liability increasing in value. Watch, assets plus, liabilities plus, owner's equity remains unchanged. Let's take that same transaction and apply it using the periodic system. Watch. bought merchandise on credit. Okay, here we go. Account debited is purchases. Account credited is creditors control. Notice the change. Instead of using a trading stock account, whenever we're dealing with periodic, we're using the purchases account. Effect on the accounting equation will be owner's equity minus Y. Purchases is regarded as an expense, and your liabilities increase because you are owing more money to your suppliers. So here you've seen two transactions and how they impact in terms of the accounting equation, in terms of the account debit and the account credit. Let's continue. Okay, the instruction says, compare the periodic and perpetual inventory systems by analyzing the following transactions of Ruth Traders. Goods are sold at a cost price of 100%, and example, bought goods for 2,500 by EFT. Okay, let's take the first one. Here are all my transactions. What we're going to do is we'll take each transaction as a standalone and then do the comparison so we can see what is happening. Right, first transaction. Purchase goods on credit from SW Wholesalers, 2,500 less 8% trade discount. Let's start with the perpetual first. Perpetual, we know. Account debited will be trading stock. Account credited will be creditors control. Why? Because we have purchased goods on credit. So debit trading stock, creditors control, that is using the perpetual inventory system. Let's change that now to the periodic inventory system. Watch, account debited is purchases. Your account credited obviously is creditors control. Look at your amount. Your amount is important. Goods were bought for 2,500 less the 8% trade discount. So here we go. All that we do is we say 2,500 times the 8% will give me a figure of 200 Rand. Take your 2,500 minus the 200 will give you a figure of 2,300. There we go. And that's the calculation, the explanation, 2,500 times 92%. Now, the question arises, why are we not recording the discount? Very important, guys. Whenever you're dealing with trade discount is never ever recorded. You only use the net amount. Okay? Keep that at the back of your minds. Trade discount is never ever recorded. Okay, the next one. It says here, received an invoice for 200 Rand from TT Deliverers for the transport of goods on a goods purchase from SW Wholesalers, right? Okay, let's take this transaction firstly using the perpetual inventory system. Here we go, perpetual inventory system. Account debited is trading stock. Notice, you don't keep a separate account for the delivery expense. Creditors control because it was done on credit. So clearly you can see if we take this now using the periodic inventory system. Here we go, periodic inventory system. Account debit is carriage on purchases. A completely separate dedicated account. Okay? And a debit to that account because it's an expense. A credit to my creditors control because that's my liability. And the amount is 200 Rand. You can see what we're trying to do here for you. We're showing you the same transaction using both the perpetual system and the periodic system. So in that way, you can clearly identify how do you deal with it regarding perpetual system, how do you deal with the transaction using the periodic inventory system. Okay, next transaction. Some of the goods purchased from SW Wholesalers were badly damaged. A debit note was issued for the goods returned. Okay, here we go. Let's start with our perpetual first. In the perpetual inventory system, account debited will be creditors control. Why? Because your liability is decreasing in value. Your account credited will be trading stock. Why? Your asset is decreasing. You've returned the goods to your suppliers. Okay, now take that same transaction using the periodic inventory system. Here we go. Account debited is creditors control. Notice the same account, but your credit is creditors allowances. That is important. Okay? And clearly it was based on the previous one, so the amount was the 460 Rand, because there was a trade discount. I've explained that already, so I'm just showing you that figure that you get would be related to number one. However, what is important now, notice I'm using a new account called creditors allowances. Now, very often you could also find that in some instances the account credited here could have been your purchases account. That is also acceptable. However, it is first preferable to take it to your creditors allowances account and then transfer the total creditors allowances to your purchases account. However, if you're doing a calculation and if you want to subtract your return directly from your purchases, by all means, hunky-dory, no problem at all. Right? Okay, that transaction is done and dusted. Let's move on to the next one. Again, we're comparing our perpetual to our periodic, starting off with our perpetual. Goods sold on credit, debit debtors control, credit sales. When we're doing it with the periodic inventory system, what are we saying? Debit the debtors control, credit the sales. Right? No problem. Amount is 1,200. Now look at the next one. If you do your comparison here, right? And on this slide here, I've done something unique for you just to show you that when you're dealing with a sale, notice with the perpetual inventory system, there are two transactions, one with the selling price, one with the cost of sale, right? Whereas when you're dealing with the periodic inventory system, there's only one transaction with the selling price, right? Obviously, this calculation here dealt with the calculation when we did the cost of sales calculation, obviously using the markup that was given to us. There's my calculation to give me my calculation of my cost of sales. But what I needed to highlight here for you was the fact that in the perpetual inventory system, when we sell goods, there's two entries for perpetual, whereas periodic has one entry only the selling price. Okay. We now look at the trading account. If you're using a perpetual inventory system, in your trading account, you've got three components. What are those three components? They are your sales, your cost of sales, and obviously the profit and loss, which is your gross profit figure that you calculate. So the trading account of a perpetual inventory is pretty straightforward. Sales, cost of sales, and your profit and loss. However, when you're looking at the purchases account, when you're using a periodic inventory system, watch, there's your total that you brought forward from the previous financial year, right? Then your bank, which is your cash purchases, your credit purchases, and you may have bought goods from petty cash. How did my purchases decrease over the year? Watch, it's your donations, it's your drawings, and it's your creditors control. Remember I spoke to you about the creditors allowances? That's the return that I'm referring to. And then obviously, this is the amount that you're going to transfer from there into your trading account. Now watch this here. This is my trading account, where I'm calculating my cost of sales. Watch, opening stock, plus purchases, plus carriage on purchases, right? Then I bring in my sales component, I bring in my closing stock component, and there's my profit and loss. So in my trading account, I don't see the cost of sales as a standalone figure. Rather, all of these components together will give you the final figure, namely your profit and loss, which is your gross profit. Okay, so if we summarize this segment, we looked at the effect of transactions using both perpetual and periodic. We've shown you the accounting equation, the account debit and the account credit. We also looked at the difference between the trading account of a concern using the perpetual inventory system and one using a periodic inventory system. Okay, please make sure you can clearly distinguish between the two trading accounts. Very, very important. Let's take a quick breather and we'll be back in a jiffy. Welcome back, accounting boffins. I hope you had a good break and you're ready to concentrate. I need your mind, your body, and your soul to be with me. Good. Let's go for it. Okay, quick recap. Remember, we're dealing with our two stock systems, and we said that when dealing with a periodic, the emphasis is on the purchases account, and when we're dealing with perpetual, the emphasis is on my trading stock account. Okay. The question says here, use the given information on transactions to calculate the cost of sales. So clearly, if the question says calculate the cost of sales, immediately it's giving you an indication that this business is using the periodic inventory system. There's your transactions. Purchased merchandise from Rizo Limited and paid by EFT. Purchased merchandise from Mabuya Wholesalers for 105,000. The invoice includes delivery charges and a trade discount of 3,000. Sold goods on credit to S. Naidu for 90,000. Those are just your transactions and your informations. You return merchandise. You sold goods for cash. And there was a return by S. Naidu as well. Then you have additional information in terms of your stock on hand at the beginning of the year and your stock on hand at the end. Okay, now, each of these transactions is going to impact on the calculation of your cost of sales. Watch here. If you start off by saying, fine, if we need to work out our opening stock, clearly you would go back to your information here, identify your opening stock, and remember that that's the figure you're going to slot into your opening stock component. So this is your calculation. This is what is expected of you, right? Okay, next. In terms of my purchases, here we go. We got the first item we have here, purchased merchandise and paid by EFT. That was 35,000. So if we take that figure of 35,000 Rand, right? And then let's go back to the previous one. We have additional information here. Let's identify it, right? Then we purchase merchandise on credit for 105,000 Rand. So there's my 105,000 Rand there. Remember, I'm working out my net purchases. Okay, then let's just tick off as we go. So we've dealt with that one. We've dealt with that one. This invoice includes delivery charges of 1,000 Rand and a trade discount of 3,000 Rand. Okay, then we sold goods. Okay, so we're looking at the purchases figure. Then obviously what you're now going to do is you're going to take that to determine your net purchases figure. Okay, so take all the information regarding your purchases, do your calculation, and then determine what was your net purchases figure. Okay. They also told you, in the transactions that we've been dealing with, that there was one of the invoices that had a delivery charge of 1,000 Rand. Remember, that delivery charge has to be shown as a separate component, 1,000 Rand, for my carriage on purchases. So in this way here, you can see that based on the given information, you are expected to calculate the cost of sales. This added together will now give me my opening stock of 105,000 plus the 134,000 Rand net purchases, right? Plus the carriage on purchase of 1,000 Rand, which will then be equal to my 240,000 Rand. Remember, that becomes your merchandise available for resale. So here we go. This becomes your cost of goods available to be sold, namely the 240,000 Rand. Okay, just while we're on this here, a bit more explanation. In this particular example, obviously it's limited. You can't get an example with all the variables in it, right? So take note of the following. You needed to work out your net purchases figure, right? When you are doing your purchases figure, take the following into consideration. Your purchases for cash, plus your purchases on credit, less your returns, less any drawings or donations of merchandise, all of that goes into your purchases account. This will then give you your net purchases figure, right? So that's the net purchases figure that we're referring to there. Okay. Now add the components. Add your opening stock plus your purchases plus your expenses on purchases. In this case here, it was only the carriage on purchases to give you your merchandise or goods or the cost price of goods available for resale. In other words, in your business for the year, you had merchandise or goods available to resale to the value of 240,000 Rand. Okay, now we go back and we find out that we have additional information here. The closing stock amounted to 140,000 Rand. Therefore, you bring in your closing stock figure of 140,000 Rand. And notice, we've said this before and we're repeating it because repetition is beneficent for a learner. Watch. 240,000 less your closing stock. That means do the operation of subtracting your closing stock. Always remember this in your calculation. Subtract your closing stock. So therefore, we have the 240,000 minus the 140,000, which was my closing stock, which will give you obviously a figure of 100,000 Rand as my cost of sales. So there my cost of sales is now calculated. Okay, continuing with my calculation. If I now am asked to calculate the gross profit, I know that my gross profit is what? It's my sales. Again, when we say net sales, what are we referring to? It is sales less debtors' allowances. Another examination tip for you. Whenever you are doing a question, whether it be financial statements, periodic inventory, the moment you see debtors' allowances, the first thing that you do is you subtract it from your sales figure. So in an income statement, you'll start your sales in your bracket minus your debtors' allowances. Don't close the bracket because there may be other information that will impact on your sales component. So take your sales minus your debtors' allowances. The same thing here. It is your net sales figure, right? And it may be good practice to actually show your calculations in brackets, even in this type of calculation, where you take your sales less your debtors' allowances to give you your net sales figure. So there we go. We've got our net sales figure, right? Now watch. We've got our sales figure of 126,300. So 126,300 minus what? The cost of sales. Now, where does that cost of sales come from? That cost of sales comes from your calculation. Let me just use another color to illustrate it better for you. Watch here. That cost of sales is what you're going to slot in to your calculation here, because you calculated the cost of sales. As you can clearly see, there's your 100,000, which you bring into your calculation here, sales less cost of sales, which will then give you your gross profit of 26,300. Here you can see 126,300 minus the 100,000 to give me a figure of, there's something wrong there, 126,300 minus 100,000, okay, will give you 26,300. So therefore, looking at this here, you can see there's your 26,300 as your gross profit. Okay, so we're done and dusted with that question. Let's move on to the next question. Pavuka Traders uses the periodic inventory system, so we know what they're doing. JCan, the owner, took goods with a cost price of 15,000 Rand for personal use. He decided not to record this as drawings. He knew that it would just reduce his profits. Again, look at the type of question that you are expected to answer. Number one, is this a fair business practice? Motivate your answer. What are the consequences of the above transaction? Okay, let's look at it. Here, number one, it is unethical. Remember, the owner and the business are two separate entities, and therefore, all transactions that the one enters into with the other must be recorded. Therefore, you have two owners' accounts, namely the owner's equity, which is your capital account, and you have the drawings account. The one account, the owner's equity account, represents what the business owes the owner. And number two, the drawings account represents what the owner owes the business. I repeat, equity account, capital account represents what the business owes the owner, and the drawings account represents what the owner owes the business. Two distinct accounts, both relating to the owner. Right. Remember, it is unethical to do that, and the owner will reduce the tax payable by 15% of the 15,000 Rand. Okay? Now remember, this ties in, obviously, with the VAT component, which is applicable to certain grades. You must also know that even if the owner takes goods for personal use, the owner will be subjected to VAT. And therefore, you will see that this transaction has to be recorded. Also, because it has tax implications, we know that legal action can be taken by SARS. So therefore, what is very, very important for you to note here is that look at the question that is being posed and look at all the possible answers that you could have on this particular type of response. Moving on, we come to Bezies Center, which sells fabric and dressmaking products and uses the periodic inventory system. The financial year end is the 31st of October. Our question is, explain one difference between the perpetual stock system and the periodic system. So we're explaining one difference between what? Perpetual and periodic. Here we go. What's the answer? In your perpetual stock system, cost of sales is calculated at the point of sale. It means when you sell goods, you record the cost of sale. Stock value can be determined, identified from your records at any time during the year. Why? Because you're keeping a continuous record of stock. 3, cost of sales, you're using a cost of sales account. That means a dedicated account determining the cost of the goods, and stock is regarded as an asset. We've given you much more than what is required, but just to make you aware that these are all the differences, or these are unique to your perpetual inventory system. If we look at the periodic inventory system, what do we find? We find that you only calculate your cost of sales when at the end of the financial year, right? Stock can be determined. Now, if you need to know how much stock you have on hand, your records are inadequate because you haven't recorded. You've recorded the inflow of stock, yes, but you haven't recorded when goods were sold. Therefore, when you're doing the periodic inventory system, you can clearly see that you are unable to determine the value of your stock at that given time. What will you have to do? You'll have to take a physical count to determine the value of your stock if you are using the periodic inventory system. So, to recap what we have done in this segment of the lesson, remember, we looked at all our calculations when it came to the calculation of cost of sales, right? Very important. You'll notice that the cost of sales calculation is of paramount importance when we talk about the periodic inventory system, right? Also, we know that the cost of sales that is calculated is used to determine our gross profit, which will be our sales less our cost of sales. Right, guys? We'll take a quick break. When you come back, we'll do the final segment to today's lesson. See you just now. Welcome back, Accounting Boffins. Remember, we are busy with stock systems. Now keep this in mind that we have two stock systems. Namely, let's go through them again and identify the key components when we're dealing with the periodic system. Remember, you're dealing with the purchases account, and when you're dealing with the perpetual inventory system, you are dealing with a trading stock account. Right? So that will give you a clear indication of what the two systems entail. Right, let's move on with the question, and it says here, Besi Center sells fabric and dressmaking products. The business uses the periodic inventory system, so they are using the periodic inventory system to record the stock. The financial year end is the 31st of October 2020. Okay, now, transaction number 1. Transport cost on trading goods paid by EFT amounted to 92,200, right? Number 2, damaged goods returned to creditors for 45,300. Let's take the first transaction because the question says, analyze the transactions 1 and 2 in terms of the accounting equation, complete the table provided, show an increase with a plus sign and a decrease with a minus sign for assets, equities, and liabilities. All right, so here we go. This is the table that we have to complete. The table says transport costs on trading goods paid by EFT 92,200, and obviously the second one, let's take them independently. Number 1, transport cost on trading goods paid by EFT 92,200. Watch, account debited is carriage on purchases, account credited is bank. We're assuming that bank is favorable. Are we? No. Let's look. Yes, here's a classic question. And I think we put it there for a particular purpose. So watch this. Account debited is carriage on purchases. Clearly you can see here that your equity is going to decrease by 92,200, right? This, in fact, is not the case because And the reason we put them both there is to show you that if bank was favorable, right? If your bank was favorable, then it would mean that your asset would decrease by 92,200. So I'm showing you both. However, when your bank is unfavorable, right? Now watch what happens here. This is when your bank is unfavorable. Now your bank account is no longer regarded as an asset, but it's now regarded as a liability. So watch this closely, guys. And it was done specifically with this in mind to show you that if your bank is favorable, then bank is regarded as an asset, and if bank is unfavorable, then bank is regarded as a liability. Okay, so keep that in mind. Right, the next one says, damaged goods were returned to the creditors for 45,300. Account debited is your creditors control. Here we go. You're debiting your creditors control. Why? It's your liability account decreasing in value, therefore debited. And you credit your creditors' allowances. Remember, this is the account we specifically set up to record all the goods that we are returning to our suppliers. So you debit your creditors' control, credit your creditors' allowances. Now watch this here. Watch. Your equity increases by 45,300, and you must be asking why. Let's do the liability first. Creditors control, obviously we know, will decrease because we are returning goods, clearly. So you're owing your creditor less money. But why is my owner's equity increasing? Now this is the reasoning behind it and the understanding of it. When you are returning goods, creditors' allowances will eventually be subtracted from your purchases. So now, because it's going to decrease your purchases, it's going to increase your owner's equity. And that's the reason for the plus 45,300 in the owner's equity account. So keep this in mind. Creditors' allowances will eventually be transferred to your purchases, and it will reduce your purchase. And therefore, we know purchases as an expense. And when you reduce your purchases, you are actually increasing your owner's equity. I hope you understand that. All right. Now the question says, calculate the cost of sales for the financial year ended 31st of October. And here we start off by saying, my stock on hand was 98,350. So the first thing that I do is, in my calculation, watch. I start off with my opening stock of 134,600. What I'm also doing for you, I'm showing you the same calculation as a calculation, and I'm showing it to you as a formatted question, depending on what is asked in the exams. Because if it says calculate, you can do it any way you want to do it, because the question didn't specify to say use the answer book to show the calculation of cost of sales. It just said calculate the cost of sales, right? Okay, so we've got our opening stock and we've taken it into account. Now we have cash and credit purchases of trading stock 622,400. So therefore, watch, we add the 622,400, and if we are doing the calculation, we say purchases 622,400. Right. So what I've done is, like I've explained to you early on, I'm showing you a straightforward, just where you just show figures, but you could be asked to show it in a table format. Then obviously you need to specify the detail. Right. If we take the next item, which was, so we've dealt with that one, transport costs paid by EFT 92,200. In my calculation, I'm going to add my 92,200. In my table, I'm going to bring in the freight, because that's the cost that I incurred in bringing the merchandise from the point of purchase to the point of sale at my business, in other words, where I'm going to be selling the goods. Next one that we have here is the damaged goods returned to creditors 45,300. Watch, in my calculation, it's a minus. Why? Because those goods were sent back to my suppliers. They were damaged goods, so it had to be returned to my creditors. In my table calculation, there's my return shown in brackets to indicate that I have returned those goods to my suppliers. Right? Going back. And the next item is goods donated to a local school that were fundraising, 5,500. Watch here, minus the 5,500. Whereas in my table, again, donations specified in brackets. Can you see? It's in a bracket indicating that I am subtracting. Right. The next item that I have here is goods taken by the owner for personal use, 3,750. Just a word of caution here. Don't just be careful how it reads. If it just says drawings, drawings could be cash or stock. But be careful. In this case here, we're only dealing with stock as a drawings figure. So that's the amount that we require. It says here, goods taken by the owner for personal use, 3,750. Therefore, minus 3,750. Watch in my table, drawings, 3,750. Okay, now another question arises here. That if you were asked to calculate the net purchases figure, right? Look, I'm changing the question slightly because I want to explain the concept to you. If you were asked to do or calculate the net purchases figure, how would we do that? Watch what we'll do. We'll take our purchases figure of 622,400, right? Plus the freight of 92,200, right? Minus my return of 45,300, minus my donation of 5,500, minus my drawings of 3,750, and this will then give me a figure of 660,050. Now, watch. This 660,050, 660,050, this figure here is actually a combination of all of these here. Can you see that? Watch here. The 660,050 is your net purchases figure. And what makes up net purchases? It will be your purchases, add your freight, minus your return, minus your donations, minus your drawings. So the combination of all of that should give you a figure of 660,050, right? Let's just check if we did the correct calculation. It was 622,400, we got that, plus the 92,200, we got that. Then we've got let's carry on there, there we go, minus the 45,300, which was my return, minus the 5,500, which was my donations, and then minus the 3,750, which was my drawings. Then eventually it gave us our answer of 660,050. Okay, there we go. Let's continue with the question. Then the next part of the question said, we've done the cost of goods returned by debtors taken into stock. Okay, now watch this here. The cost of goods returned by debtors. Obviously, that particular item there is your debtors allowances. Now remember, debtors allowances is not going to impact on my cost of sales. It's going to impact on my sales figure. So therefore, be careful. Don't just assume that everything will go into the calculation. So this is actually my debtors allowances, right? So cost of goods returned by debtors taken into stock will be 7250. That will be my debtors allowances figure that I will subtract from my sales figure. Okay, but for cost of sales, I also know that I was given other information. Let's identify it. Stock on hand on the 31st of October amounted to 98,350. So therefore, I bring in the minus 98,350. And in terms of my table, there we go. Closing stock 98,350. What do I now do? I take all my components to determine my cost of sales. Let's do that. Okay, so here we go. It's a 134,600 plus 622,400 plus 92,200 minus 45,300 minus 5,500 minus 3,750 minus 98,350, and that will give you 696,300, which is the cost of sales that we were expected to calculate, 696,300. Okay, now that is your cost of sales component. Now watch this calculation, guys. Important. Opening stock, purchases, or net purchases, depending on whatever the question is asking you to calculate. I've shown you both the calculations, and I've also shown you the permutation in terms of the calculation here. Watch. If you are asked to do this calculation in a calculation format, then that is what it will look like. But you will get the same answer, 696,300, and if you're doing your table, there's my 696,300. Okay, let us summarize. In terms of periodic inventory, we know for one, the emphasis on the purchases account. Record all the components that you need to calculate cost of sales. Opening stock, net purchases. What is net purchases? Purchases, less returns, less donations, less drawings, right? Add expenses on purchases, like what? Carriage on purchases, import duties, customs duties, all of them. Do not include carriage on sales. We've alluded to this before, just a reminder. That will give you merchandise available for resale, less your closing stock will give you your cost of sales. Eventually, you take your sales minus your cost of sales, and that will give you your gross profit. From me, Ashraf Patel, and the team, guys, keep on practicing your accounting because we want you to ace your exam, right? Remember what we always say? Keep your feet on the ground. You will definitely reach and become an accounting shining star. Until the next time, be good. Goodbye.